People are constantly believing that the markets have changed. And I do not believe that the markets changed. I mean, the markets may be controlled, where there's outside influences, but that tends to just stretch the markets out. It's like a rubber band. It just stretches out and then they snap and you're right back into what you would expect to see the markets do. So the trending environments, they may take longer to come to fruition, but when they come back with a vengeance.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where today Alan Dunn and I are joined by Marty Bergin, the owner and president of DUNN Capital Management, which also makes him my boss for full disclosure, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Marty, it's great to have you back on the podcast. Thanks so much for joining us today. We really have been looking forward to our conversation. I hope you are doing well. I know you just recovered from a little cold.
Yeah, thank you very much. It's been quite a while since I've been on the podcast. It's nice to be back, and it's nice to be joined by Alan.
Good to speak to you too, Marty.
Yeah, with Alan
been a
in
while.
the past.
Absolutely. Now, before we dive into the various topics, Marty, that we have planned for, maybe just to set the stage for the conversation and to give our audience a little bit of context, do you mind just talking a little bit about the background of DUNN, and also perhaps you can share kind of the type of strategy that DUNN focuses on, and kind of where we sort of stand today in terms of the business as we head into 2023?
All right. Well, I think everybody knows we're a trend follower. We've been around for quite a long time, over 45 years. And William Dunn, who is a founder of DUNN Capital, is actually one of the fathers of the industry as a whole. And he was actively involved in the regulatory background for CTAs and managed futures. He was the main researcher at DUNN originally. Designed the systems, were completely systematic. There are still elements that Bill designed back in the early 70s that are in the system today. And of course, as technology has advanced and capabilities have grown, the systems are much more technologically advanced than they were back at that point in time. But we essentially are still doing the same thing that Bill designed in the early 70s. The firm has transitioned. Bill is no longer involved in the day-to-day activities. Firm transitioned to me. Basically, my job is to not screw anything up and keep it moving forward. We've been growing assets fairly consistently. I think our focus has been not only on the research, but also on education and trying to educate the world basically in the advantages of systematic trading as a whole, but also trend following as an example of that. So that's where we are today.
That's where
I
we are
think
today.
we're about $1.4 billion under management, and consistently the growth of the AUM has been very stable and consistent, especially over the last 5 years. And we're very proud of that.
Yeah, absolutely. That's a great context for our conversation. Now, Alan and I have created a list of topics that we're going to be discussing, and we'll kind of go back and forth between us. So, Alan, why don't you, as always, just kick it off with the kind of the first topic we want to discuss with Marty?
Well, it's interesting. It's a very interesting point that you make that essentially the models that were developed in the 1970s are still kind of, their essence is still kind of evident in what you're doing today, Marty. So, I mean, what is it about the markets, do you think, that there is a strategy like trend following that is so persistent in terms of the return stream that you can get from it over time? Where does that come from, and what gives you confidence that it will be there going forward?
Well, I think it's over my head about where it comes from. It's been very robust over the years. It's basically momentum strategies that have been around since investing began. And I think it's, over the years, people have gravitated to this idea that momentum is dead or trend following is dead from time to time. And it's been proven over and over to be false narrative. I think the key to what we do is to not lose focus on trend following. So in other words, as time has gone and advancements have been made, I think a lot of our competitors have tended to gravitate away from trend following. Some of them have publicly said, we don't believe in trend following anymore, and we believe there's other things that will do a better job of capturing alpha. And over time, maybe their performance is improved sometimes. But then when the trend following is needed or that environment kicks in, they're no longer able to provide that alpha. And I think we've done a really good job of not losing focus on what we do, which is trend following, which has been proven over the last year that there's a lot of trend followers that did not make, or people that proposed to be trend followers that didn't make outsized returns last year. Now, they may have been profitable, but I don't consider single digits outsized returns when in that type of trending environment, you should be really knocking the ball out of the park.
Sure. And I guess when you put that question to a lot of other managers, one perspective is, well, they may say, well, we still believe in trend following, but you have to balance that with keeping people invested in the strategy over time and making the strategy more digestible for people. And in that aim, that there could be a benefit from smoothing out returns, adding some other strategies that can contribute performance in those trendless periods, while still maintaining the characteristics, the broad risk profile of trend following. Is that something you've shied away from, and is that because you philosophically disagree with that? But does that give a bigger challenge in terms of keeping people invested in a kind of a pure trend strategy?
So it's not something we would shy away from, but I think there's an honesty that's involved. You can't say that you're a trend follower and you've made changes within the system that have gravitated away from trend and not fully disclose that. So I think there's a place for an all-weather type strategy, and we've actually been doing research in that area, and at some point in time, we'll probably offer an additional strategy that may be moved more in line with all-weather. But we won't be presenting it as a trend strategy. We'll present it as an all-weather. You want to present something where the investor has a clear choice that they're making. Now, I also believe that most investors are smart enough to realize that trend represents a portion of their portfolio development. And they have other strategies that are built around that to balance their portfolio. It's not my job to come up with a strategy that answers all their needs. I don't want to be all things to all people. I mean, we do what we do. We do it very well, and that's what I want to continue to offer.
No, absolutely. And I mean, would you say that's the big, when you look at yourselves versus peers, is that the big difference that you would identify? Is that singular focus on trend versus everything else?
Well, I think that's one of the things, but I think the other thing that differentiates us. So why did people start gravitating away from trend? Because they had problems being competitive in a performance environment, correct? Well, I think there's other ways that you can add that performance in non-trending environments. One is through risk management, and another is through portfolio development. And one of the things that we've really done is we've enhanced the risk management aspect of the program. I mean, one of the things we do is we got an exit strategy that's built into the program, which has been helpful over the years. But more importantly than that, we've adopted this adaptive risk profile where we actually change our risk target given the market environment. So in other words, we will add risk in a market environment that's positive to trend following, and we will reduce risk in market environments that aren't trending. And that's made a very big difference. So even in non-trending times, we've been competitive from a performance standpoint. And that's our goal. We're trying to offer people an alternative, basically an insurance project or a hedge to their portfolio without costing them a lot of money. So during the times when the rest of their portfolio should be working fine, we should still be making some money. We're just not doing as well as equities might be doing or some of their other strategies. But then when everything else is falling apart, we tend to kick in and make a big difference in their portfolio. That's the goal. And the other goal is to educate people into the idea that this isn't a strategy that you move into when you see things going south, but this is a core holding that you should hold within your portfolio. We're almost impossible to time. I mean, I can't time it, and I probably know as much about it as anyone.
Yeah, no, let's stay on the topic about focusing on trend, because I think that is a key difference. But also, as you say, Marty, that we made some improvements, of course, and to some extent. I mean, Cliff Asness wrote a paper last year where he questioned whether the industry had become too concerned or focused on Sharpe. But what I hear you say is that there are ways to improve trend following, without necessarily deviating from trend following. So how do you balance that in your mind, or does it drive your view whether we should try to deliver trend following with a in a nicer package, so to speak, with a bit higher Sharpe? Where would you draw the line between that and saying no, we're just kind of trend, because long term we think that's a better strategy, even if it's a little bit more bumpier along the way?
Well, I think the goal should always be to improve. And whether you measure that with risk-adjusted returns, Sharpe Ratio, or some other measure, drawdown, or ratio of performance to drawdown, I mean, there's all different ways to measure performance or success in our business. I think there is too much focus on Sharpe Ratio, although I also am not a believer that it's an absolute return type strategy. I mean, there has to be some give and take. I think the hardest thing to do from the research perspective is to not lose focus of what you're trying to do. I mean, it's easy to gravitate away from trend following when you see something that will enhance performance, but you got to ask yourself, are you still doing what you say you're doing? And we have always been very strict about wanting to perform during trending environments. I mean, we expect to have outside performance during those periods of time, and that's the goal of the strategy. Now, if we develop something that's different, that's fine. And if we think it's a good quality product, we'll offer it to the community, but it will be offered as something different.
And is that what you feel that stood out last year, 2022? Obviously, performance stood out, but also, was it just by all measures of account an incredibly trending year in your opinion, or was it, if I'm trying to be objective here, was it also the fact that maybe the markets we trade compared to people who trade 200 markets were a little bit more trending, perhaps, or maybe a combination of the two?
There could be some of that, but I think it's really just a focus on, I call 2022 a year of validation for trend followers, because I think a lot of people in the industry lost focus, started gravitating away from trend, and the people that stayed the course and believed in the trend kept that as the focus of their systems, were validated in their belief. And, we had that core belief. We knew that it was just a matter of time before this would fall back in favor. You have to play through the whole investment cycle, which we have done now. And I think not only has it been validated as a core strategy, but I think it's been recognized in the investment industry as a focus going forward for portfolios.
Yeah, no, I was just going to follow up on that, actually, because that's an interesting point. Do you feel that this is a little bit different to 2009, where, again, on the back of a very strong year, I think a lot of us felt that, oh, wow, this is going to be an amazing time to get institutional adoption into the strategy, but it turned out to be a little bit harder. Do you think that there's something different this time around, maybe?
Yes, I think institutionals are recognizing things a little differently this time. I believe that 2022 was a year of inflation, and we haven't seen the recessionary trade yet, which I believe trend followers will also benefit from. I think the other thing that's different is now institutionals who in the past have felt like their allocation to fixed income was their insurance policy, that obviously didn't work. And they're seeing the value of trend following as part of that protection. But I think the other thing that's going to happen is institutionals have also made very large allocations to private equity, both in real estate, private equity, and equity markets. Now, I believe there's going to be a lag in the pain that's going to be felt in those allocations, because the marks are basically internal. So people will tend not to show the bad performance for a while. It'll lag the markets. And the liquid alts is going to be the hedge to the non-liquid alts. And I think institutional players are going to start realizing that and be looking to trend following and CTAs as that liquid hedge to their private equity allocations.
Yeah, no, I agree with that. And I actually think one thing you're absolutely right about is the fact that we've seen in the last few years this term risk mitigation. And we're now seeing that parts of institutional portfolios are being labeled risk mitigation. And actually the core part of the risk mitigation portfolio, so to speak, is actually trend following. So I agree with that. And obviously we hope that more people will go down that path. Alan, do you want to jump into one of your favorite topics?
Yeah, well, maybe just to follow up on what we're talking about and the lead into research, is just, obviously you want to deliver returns in the period of trending markets. But, the other point that was picked up with the Cliff Asness paper was, delivering returns in kind of crisis alpha periods or equity down markets. And I'm just wondering, how does that play into your mind in terms of thinking about the speeds of systems? And obviously, if you're kind of slower or medium to slower, you'll stick with the trends, but might be a bit slower to respond at equity turning points. So, is that something you worry about, or is that an argument for having some element of more responsive systems as part of the suite, or not? And is the focus primarily on not worrying about those kind of short-term reversals and focus primarily on just capturing those big moves in markets?
So that's something that we've done a lot of thinking about. And I think the main driver in that has to do with drawdown. So what we've found over the years in research is shorter time frames or shorter look back periods can mitigate drawdowns. But we also know that from a performance standpoint, the performance is not as good. But it's become aware to us that institutional clients aren't necessarily looking for the knock the ball out of the park kind of performance. They're more concerned about that drawdown. So we are toying with the idea of restricting some of the look back periods with the idea of being more flexible in terms of, just like you said, the shorter time periods to move quicker against equity drawdowns, knowing that the overall performance is not going to be as good, but it may be providing a product that there's clients out there that are looking for. And then again, it's just an idea of full transparency and being upfront with people about what it is they're getting.
Absolutely, and I suppose you hear people talking about the utility that you get from different programs or investment offerings, and the utility from that kind of return profile for certain types of investors may be greater than the utility of a higher return, but with a less favorable drawdown profile.
Right. So at DUNN, I mean, we've always been really focused on providing what we think is the best overall product. And maybe we haven't been as receptive to what the institutional investor was telling us. So a lot of the institutions may not gravitate toward DUNN just because of the type of product we offered, which was what we consider the best product over the long term. That might not have met their needs. So we're now probably going to be more open to addressing what the investors are looking for, just making sure that it's clear what it is. And if it's a different product, which we feel isn't going to generate as large of a return over a long period of time, but it may meet the needs of the client.
Yeah, no, fair enough. You touched on two enhancements, I guess, you've made to the program over the years. One being the exit strategy, and the second being this adaptive risk profile. So clearly, this has been the kind of the result of research. How do you when you do research? Obviously, when you do something looking in the back mirror, presumably it'll look better. And how do you think about, well, okay, this would have worked better in the past? How do you make the assessment of it's likely to continue to be better looking forward?
Well, it's all about not data mining, right? So you don't want to trick yourself into believing something that isn't true. And I think that's the hardest thing that we, from a research perspective, we're very focused on that aspect of it. We want to be regimented. We want to be robust about our research. I can honestly tell you that the majority of everything that we get involved in from a research perspective doesn't pan out. I mean, when you've been around for 45 years, there's a lot of things that you've looked at over time and a lot of things that just, I mean, you tend to revisit things over time to see if maybe there's something that we missed that does improve it. But for the most part, most of the projects just don't pan out. For us to have something like the adaptive risk profile, and most of the time these things grow out of research you're doing in a different area, and you just kind of haphazardly fall on something that, hey, wait a minute, there's an idea, and you start moving forward with it, and oh, lo and behold, it works.
Does the research tend to come in response to a difficult period that you identified something that you're trying to solve, like the drawdown was very severe, or the give back in a number of individual trades seemed to be very large, so that might be better? Is that what tends to happen?
I think you tend to work a lot harder when you're going through bad periods. But the truth be told, there's such a lag time in research that something may start during a period of time of poor performance, but by the time it's actually implemented, the markets have changed drastically. So it's just an ongoing thing. And I think the key to it is to maintain the communication and the dialogue internally within the group and be constantly talking about different ideas and different things and being open to ideas, both internally and externally. I mean, a lot of things come out of reading papers that are presented. And you might not end up implementing anything that has to do with the paper, but the paper may jog another idea that you have to implement something.
And you mentioned at the start how, the essence of those original Bill Dunn models from the 70s are still, underpinning a lot of the current models. But I think you had the expression technologically more advanced. But I mean, outside the execution and the technology and the way of running and monitoring all the systems, in terms of the signals, if you were to run those kind of 1970s models on today's markets, would they still be working, and how much better?
Yeah.
They would, yeah. Okay.
Yeah, trend following is not rocket science. I mean, there's only so many ways to, determine trend. It's time and noise. I mean, it's very straightforward. So the reality is what generates the signal hasn't really changed over the last 100 years. It's the way you implement that signal that's changed. So the risk management aspect, the data aspects, the trading aspects, the portfolio development aspects. I mean, think about it. In the early 70s, there's only a handful of markets that have futures contracts. So as time has changed and more futures contracts are available to you, that diversity is a real advantage to what we do. We look at markets, and we look at markets that can provide a diversified revenue stream to what we already have. That helps mitigate the risk. Now, there's a whole lot of markets out there that have futures that aren't really viable for one reason or the other. Either they don't have the volume to trade it easily, or the exchange they're traded on might not be something that you would trust, whether they're regulated or non-regulated. We don't trade any futures contracts in China, for instance, because I'm just not comfortable with the counterparty risk. And when you think about it, all our private net worth is involved in these systems. I mean, we invest in the same systems that we offer to our investors. And, I don't want to take that risk with my own money. So why would I take that risk with investors' money?
Fair enough. You also mentioned one of the other enhancement was, or one of them was the exit strategy, that was significant. Is that like a profit take type enhancement, or is it kind of?
It's not a stop loss criteria. It's more of a profit taking type enhancement. Where we see trend following's weakness is, you tend to get in the trend slowly and you get out of the trend slowly. And the idea is to get into the trend slowly, but accelerate getting out of the trend. Now, I will tell you, there are times when the exit strategy is a benefit, and there's times when the exit strategy is not a benefit. And I would say over the last year, it hasn't been a benefit. But it's, the positives outweigh the negatives. So we're not going to remove it just because of a short period of time where it didn't provide a benefit.
And maybe just one final point on this. A lot of kind of the old school traders who started off running technical trading systems, saw their portfolio as a bunch of individual trades. So you get discrete signals in different markets, and it aggregated up into a portfolio, but they were essentially managed.
Yeah, that's how DUNN was originally too.
But whereas kind of the more European perspective is often looking at the overall portfolio and managing the risk from that perspective. So was there an evolution then in DUNN's history from the original kind of approach to the more portfolio approach? And was that, I guess, as you added more markets, or how did that evolve?
Yeah, and basically in 2006, we gravitated away from looking at individual markets. So we would basically develop an individual market and then put all the markets together and come up with our risk sizing after the fact. In 2006, we decided to take a more portfolio view where we use the same parameter picks on every single market we trade. And the only thing we're interested in is what the effect of the overall portfolio is. By doing that, it makes the system more robust. Less chances of data mining, more chances of being adaptive to whatever the given market will be going forward. And that's the key to everything we do is you want to be robust and adaptive to the market conditions as they change, because you have no way of predicting what's going to happen in the markets going forward. So we're basically counting on the system, the systematic automated nature of the system, to adapt to whatever the market conditions are. I mean, thank God people don't have to rely on me sitting in my office going, oh, I see this going forward, let's make this change. We're counting on the system to do that automatically.
Yeah, no, I just want to stay. I mean, you've covered a lot of ground, some of the things that I had planned, but I want to stay with the number of markets a little bit, because I do think that DUNN is maybe a little bit different in that group as well when it comes to markets traded. We've seen a lot of our peers embrace, hundreds of markets traded. So besides obviously liquidity as such, I mean, do you have a view on what you feel is a realistic kind of quote unquote maximum number of markets that actually exists, that gives enough diversification benefits without giving up any liquidity concerns? I mean, is it 60 markets, do you think, nowadays, or is it 100? Where do you see that evolution?
Well, all that I can speak to is the way we view it internally. So we're comfortable with the number of markets we're trading. We don't add markets just for the sake of adding markets. So I believe that a lot of our peers have gravitated to such a large number of markets, mainly from an AUM standpoint. The larger the number of markets, the easier it is to manage the portfolio. But you don't want to add markets if it's not going to give you any real benefit. So we have added markets mainly from the standpoint of where we see a diversification benefit. So we've added some metals recently because we see that as markets that are different than what are in the portfolio. So I think we'll continue to move in that area. Now, I will say that from a diversification standpoint, I think people tend to put too much weight on it. I mean, there's studies that have been shown that it really doesn't take that many markets to be diversified. But it kind of brings us back to this new idea of people maybe duplicating CTAs through ETFs with very minimal markets. Those type of strategies work really well. I mean, the diversification during a normal market environment is not that big of a deal. But when things go south or something happens in the market and it's not a normal market environment, all of a sudden that diversification difference plays a big role. And, it's one of those things, everything works fine until it doesn't. And I think we haven't gotten to that point where it doesn't.
Is that the main risk you see in these replication strategies? Obviously, it's been a topic that we've discussed with the other managers in this series, but also generally it's been a topic that we've talked about a lot on the podcast, is this CTA replication. It started out actually many years ago where people were just trying to create quote unquote cheap trend following models, and now they're doing linear regression based on the performance data. Do you have a sense of one versus the other, or are they kind of a little bit the same in the end?
I think it's hilarious, the lack of due diligence on these type of strategies, because literally everything that's presented in their presentations is all simulated data. There is no real trading, no real execution. Everything is simulated, and people are making investments decisions based on this data that's being provided. So there's no real true history.
Not a long one, at least, that's for sure.
No. And people are allocating lots of money to it. So it'll be interesting to see what happens when, there's a little stress added to the market, and people say, oh, how did we get involved in this? Or we didn't expect this to happen. We'll see.
Yeah, absolutely. Time will tell. Speaking of risk and drawdowns, Alan, is that where you're heading next?
Yeah, I mean, we've touched a little bit on kind of some of the approaches you've made in terms of kind of drawdown and also the portfolio dynamics as well. One of the topics that comes up a lot, and we don't want to dwell on it too much, I guess, is the whole dynamic versus static position sizing. But it sounds like you went through that kind of evolution in that 2006 shift more towards. Prior to that, what was it? Were position size more individually and allowed to run like the classic trend follower? Whereas, if the volatility picks up, that contract will have a large contribution to the overall portfolio. And then did you decide to kind of move away from that?
So dynamic risk sizing, which is one of those topics that, people can just lose hours discussing. And people in the industry have very, very emotional ties to both ways of doing it. I'm not emotional about it. I have no problem with people that use the old style methodology of sizing positions, where basically you enter the position based on the volatility, and you don't adjust that position until you trade out of the position or you roll the position, and you may adjust for volatility at that time again. I don't have a problem with that methodology. It has a place in trend following. The whole idea is that as the volatility picks up, then the trend should be stronger, and you should want to stay in that position, and you've added risk automatically to your positioning. But what we do feel is institutional investors, and from our comfort level, if we know that the risk has changed and we're targeting a risk dynamic, we want to adjust a portfolio to that targeted risk. So we are going to dynamically size our positions on a daily basis. And one of the things that we will take into account for that is going to be volatility. We're also going to look at correlations and trend strength. And we're going to plug all that into the risk dynamic of the portfolio. So we're a true believer of dynamic sizing. I don't have any problem with people in the industry that aren't. And I think there's a place for that.
And obviously you're looking to generate outsized returns when markets trend, but could you generate even more of a kind of a positive skewness, more of a convex return profile if you didn't volatilize the position? I guess that's the other.
Yes, I think I absolutely. I think that's true.
Yeah. Okay.
But you're giving up something, right? You're giving up control over the risk. So you have to measure one against the other. And I think if you look at CTAs, I think the skew has come down as an industry, as more people in the industry are dynamically sizing positions.
I guess you're kind of capturing two different things. One is trends, and then another volatility expansion is another feature that
Yes.
And if you have that more static position sizing, you can get exposure to two factors. And obviously people, I guess, will manage the positions at different speeds. I mean, outside of that, is volatility targeting the main way you think about risk in the portfolio, or is exposure
No.
or margin?
No, I think the biggest focus that we're looking at is correlation of markets.
Okay.
So the cross-market correlations, we think, have a bigger factor on risk than the volatility.
Okay. And is that something then that you mentioned kind of shying away from discretionary inputs, but can there be periods where you can overly rely on correlation? If you have, historically we had a negative correlation, say, between bonds and equities, in the last decade in particular. If you believe that correlation, could you kind of be overly leveraged on kind of bin long bonds and equities in those periods?
Well, of course, but so there's two different things going on there. The data will tell you one thing, and you got to take your emotion out of. You may believe that there's a correlation going on, but if the data tells you something different and the correlations have changed, then obviously the system needs to gravitate with that change. So that's why it's important that it's 100% systematic. So you let the data dictate. It's not our interpretation or what we believe correlations are. It's what actual correlations are.
Yeah. How do you think about, like, what's the right look back for, say, if you want to measure the volatility of a market, or if you want to measure the correlation between markets?
We think those look back periods are constantly changing. And so the way the system is designed, it gravitates through shorter and longer periods of look back. And we don't restrict what that look back could be. Now, what I will tell you is it will never take the really short, like a week type look back, because it just isn't profitable over any length of time. And the cost associated with trading such short look backs basically eats up the profit. We haven't decided to go that route where we want to be competitive in a shorter, high frequency type trading environment. So we're comfortable with where we are, which is the medium to long term type trend following. I think there's a place for shorter term windows, but it's a very expensive and low return type environment to get involved in. So there are people that, such as Citadel and some of the other firms that are involved in short-term trading or high-frequency type environment, that make money consistently, but the cost of doing that is excessive, and I'm not going to try to compete with that.
Niels?
I mean, it's just sort of expanding a little bit on that, but in a slightly different direction. Another thing that is very much determined in terms of the time frame you trade is often linked to then the capacity that you have in your strategies. And of course, even in the trend following space, we see quite a lot of dispersion in terms of size of managers. And so I'm curious how you think about capacity, how you think about DUNN's capacity, what might give you a clue that we're getting close. And of course, that may also tie into the other question or topic that we've been discussing with our colleagues, and that is, fees, where maybe, and this is kind of my own observation, that maybe during the times when trend following, during, say, 2015 through 19, where there were some institutional inflows, but where they were also able to get some very good deals from people offering very low flat fees, et cetera, and perhaps now some of those managers who took in a lot of money at very low fees are kind of regretting that to some extent. So again, capacity fees, would love to hear your thoughts about that from DUNN's point of view, but also from how you look at the industry.
So I think one of the advantages that DUNN has is the fact that we're kind of a niche player. We're not large, so capacity is not of a concern of ours. And it brings me back to what I said earlier about 2022 is a year of validation, because we were one of those firms that had been approached by a number of institutions of offering a product at a very low fee level. Back at a time when, AUM would have been nice to be able to add easily, but we weren't willing to sacrifice kind of what we built ourselves as a zero management fee, incentive fee only firm. We've always prided ourselves as being client centric, so we weren't willing to go that route. And I think it was a big benefit to us later that, during this good period of time, we were able to benefit from it. I think there's a place for potentially offering a product from an institutional standpoint that may not be, which we talked about earlier, may not be what you think is the best product available, but it may be something that is providing a need for an investor or a client. And at that point, you may negotiate a different kind of fee structure for that particular investor. But I think from the industry as a whole, there's a lot of very large trend followers that are trading, $20 billion. So DUNN is not at that point. I believe that we're comfortable where we are, and we're comfortable if we were to double our AUM. I think if we reached a point where we were touching on 5 billion, we would probably pull back a little bit and readdress where we were. Bill used to always say that if you ever had a capacity issue, you just raise the fee and that'll take care of it. I don't think I'm looking to do that route. I mean, the truth be told, there's a lot of people that are doing what we do. So there's a lot of competition out there. I feel like the way we do it is better than most. So I feel comfort our position in the industry as a whole.
Yeah, no, absolutely. Another thing, before I turn it over to Alan, another thing that actually came up in our one of our conversations, this was with the Swedish firm Links, because they are also a little bit similar to DUNN, meaning they're off the beaten path. They're not in one of these financial centers, and Stuart, Florida is not a financial center. I think we can agree on that. How do you think about location? Do you think about that as being an advantage for what we do or a disadvantage? How do you think about that?
I see it as a non-issue. I mean, being where we are, it makes it less convenient for institutions to see us and talk to us. But in this day and age of technology, it's really a non-issue. I mean, it's easy to get on a Teams call or a Zoom call and talk to people. It's easy enough to get on an airplane and travel to see people. People want to do the due diligence. Most people are very comfortable when they come and see our offices and what we're doing. They understand why we are where we are. And, Stuart is the worldwide headquarters for DUNN. We were in Florida before everybody else started gravitating here. And, now basically every major bank in the world is opening offices up 45 minutes south of us in Palm Beach. So we were just ahead of our time.
Just wanted to follow up, on a point around, I suppose, related to markets traded, and then I suppose specifically liquidity. You mentioned not trading Chinese futures, I think from the counterparty risk perspective. So in terms of kind of market selection, and then specifically around liquidity, what's your thinking on that now? And I mean, specifically from the perspective that people present, about concerns in some markets with respect to liquidity recently. Obviously with the gilt market, we had exaggerated moves. Every so often it appears there's kind of a gap move, say like cable earlier this year. And then you had the issue with the treasury market in 2020. So Obviously you've been involved in markets and very close to markets for going back over a number of decades. So when you look at the liquidity profile of markets, are you comfortable with that? And which ones, obviously, have you chosen not to be involved in from a liquidity perspective?
So one of the things we've looked hard at is the LME because of what they did with the nickel earlier this year and the disconnect there. So we are currently, as we call it, we have them in the penalty box, and we're waiting to see how they respond to the investigation and what they implement to improve their marketplace. That's a tough one because you think about it, it's the oldest exchange in the world. You wouldn't have thought that this would be a problem. But clearly there was some internal, what I would call corruption going on, and they reacted according to what they thought was best for them, but it wasn't best for the markets as a whole. Hopefully they will implement some of the things that need to be done, and we will start trading those markets again. But the volatility profile of markets is one of the reasons why we do not trade. The trading that we do here at DUNN is not automated. So in other words, we have traders that actually execute every order that we implement. Now, they have a lot of tools at their disposal. In other words, algorithms and different things that they can utilize in the trading, but they supervise or oversee the trading. So that when you have a volume profile that's broken, if you're using an automated system, you can really get hurt in those environments. And I think some of those environments present themselves just for that reason. It's basically the computers taking advantage of other computers. And I feel like if you have a trader that's supervising that process, it mitigates that risk.
So that's just kind of managing the execution of the algorithm, or is that kind of, yeah.
Right. When you're looking at medium to long-term trend following, I mean, the execution itself becomes less important. I mean, you're not looking for that pennies at that execution point. What you're looking for is execution that is controlled, and you don't take a bath at that point. And that's when you got experienced traders that kind of control that process, that's a big advantage.
So that's something, I mean, are you kind of monitoring those traders to assess their entry or against a certain slippage budget, or how do you think about that?
We definitely monitor the slippage. We get reports all the time. I can pleasantly say that most of our slippage is positive in nature. So a big hand goes out to our traders.
Very good. There's one other topic I wanted to delve into, and we kind of talked about it earlier a little bit, and it's kind of the role of trend, within a larger portfolio. And you mentioned how maybe, thinking about being more responsive to investor requirements or demands or around that. But I suppose there's a few questions that you often get when you're out presenting managed futures to investors, and so I might just put them at you. Like one, should we think about managed futures and trend following as is it a return generator or a portfolio diversifier, or is it protection? And then in terms of funding the allocation, should it be funded more out of the equity side or the bond side? If you got those questions from investors, which I'm sure you probably have at some point, how do you address those?
Well, so first thing we start out is it should be a core allocation. So I assume under most scenarios, it's a part of their alt budget. And I would think that it would be funded equally out of their fixed income versus equity. I think in the past, it was probably just funded out of equity. I think moving forward, people will start looking at it as a funding out of fixed income, since This will probably be a replacement for part of that fixed income allocation moving forward. The other thing is, I think most institutionals will look at it from a standpoint of, they got a convexity type allocation. They may have, a long short type allocation, and then they'll have a trend following allocation. And the three of those things come together to form their alt budget potentially. Now, the convexity thing, or the black swan, the tail risk hedging that they're doing, they know that that's going to cost them money basically for the majority of the time until it kicks in and provides that benefit. Whereas I think they'll look at the trend following portion of the budget to not be a negative drag on the portfolio, that it'll be an overall positive from a performance standpoint. It just won't be performing as well during bull markets as their equity allocation. But it's an important allocation because it provides that alpha, depending on how you define alpha, but provides that alpha during crisis environments, right?
When a second topic on this kind of question, I mean, you mentioned private equity and private markets in general. And I suppose if you're sitting in the allocator seat, you might say, well, the reason for allocating to private equity, and this was the argument, obviously there's some kind of illiquidity premium. So you could say, well, you can get public market returns plus an illiquidity premium, so whatever that is. So allocators would have a way of thinking about what the returns would be. How should people think about the returns from managed futures and the potential returns from managed futures and trend following, to think about, well, okay, how much should I allocate and in what area of the portfolio? Is it all driven by what has been produced historically, or is there anything else that people should, any other kind of process to try and think about what returns are achievable?
Well, so I think that is an analysis that they have to do internally to determine what it is they're trying to accomplish, and to make sure they have an allocation that's large enough to get them there. So what we see is they tend to under allocate to the strategy, so that when it does kick in and works, it doesn't really provide them any benefit because they didn't allocate enough to it. Now, let's go back to the whole private equity allocation and be perfectly honest. I mean, why are they allocating to private equity? Because it's a smooth performance, because it's not real. There's no true mark to market. And that's kind of the negative that they get with allocating to CTAs or trend following, because it is very transparent and it is mark to market. So they see that volatility. That volatility is reported constantly. And, that doesn't provide a lot of comfort. Although it's a liquid alt. So they know exactly where their values are on any given day, and it's always available to them. Whereas the private equity is not. I mean, the private equity they set aside, it gives them comfort because they never see a big swing, but that money's not available. They don't have any ability to get their hands on it. And when it starts going south, it might be smooth and consistently going south, but there's nothing they can do about it. And I think what you're going to see moving forward is they're going to be allocating to trend followers, because when that private equity is getting down month after month after month, they'll have the trend following hedge that will be generating performance during, basically during a recessionary period.
I know we're moving up in time, so I'll hand it back to Niels. I know just a couple more on Niels' list.
Yeah, exactly. There's a few more topics that we wanted to cover with you, Marty. So one of the things actually that we have brought up with people, and just to hear your thoughts on that, for the last, 10, 15 years, this was an area that didn't require too much work, because cash management was a thing where you just had to try and stay or minimize the drag from these zero or negative interest rates. in today's world, interest rates are not zero anymore. Share with us how you think about the cash management part of the funds that DUNN manages, and and how you do that.
So we think that's really important. So most CTAs or managed futures products, I think, have overlooked the cash management aspect of it. I mean, a lot of times they just leave it in the hands of the brokers or just buy treasuries and let it sit. We've been very active because historically there's been counterparty risk associated with brokers. So we tried to mitigate the amount of money that we have with a particular broker, especially in clearing. So we have a firm that we basically own 90 or 49% of the equity of in New York that manages all of our cash. And over the last 2 years, the value of that has really come to the forefront just because of how poorly fixed income is done. I mean, you had a lot of ETFs and mutual fund bond investments that were down 16 to 20% over the last year. So managing that cash becomes a very key component to the process. And we rely on experts to basically do it. The reason we use a firm that we have some equity invested in is so that we have control over that process, or at least transparency into the process. So I see every confirmation for every purchase or sale that's done in the fixed income sector, and we keep a very close watch on it, and it's bode well for our investors. And I feel comfortable with the way we handle it.
Yeah. And of course, probably worth mentioning that obviously we're not the only CTA that they do this work for. They do it for some of our friends and competitors or peers in the industry as well. So yeah,
when we decided to go this route, the whole idea was for them to be providing this service not just to us, but anybody else in the CTA space that wanted to avail themselves of this service.
One more thing was maybe something that, I don't know exactly how what to call this kind of question, but I'm curious anyways about if there's something you hear people say about trend following, and every time you hear it, you say, no, I definitely disagree with that. Some kind of description of what we do as an industry where you say, that's just not something I agree with. Is there anything that comes to mind you've heard over the years again and again?
It seems like over and over people tell us that trend following is dead, right? So, I mean, I've heard that so many times over the years that it just makes me laugh. And I think, well, we'll see. And there again, validation during the last year for the fact that people are constantly believing that the markets have changed. And I do not believe that the markets changed. I mean, the markets may be controlled, where there's outside influences that control the markets, especially equity markets. I mean, you have the Fed, you have government intervention, you have a lot of things going on that influence markets. But that tends to just stretch the markets out. It's like a rubber band. It just stretches out and then they snap and you're right back into what you would expect to see the markets do. So the trending environments, they may take longer to come to fruition, but when they come back with a vengeance.
Yeah. Now that we also have Alan here as an allocator, I'm curious to ask you the question though, Marty, and that is, if you were an allocator and you go into these conversations with managers, what's the one or two things that you would definitely ask the manager that you maybe you don't see a lot of allocators coming in to visit, ask?
I think the biggest thing I would be focused on is style drift. I mean, you want to make sure that you're getting what you're looking at or what your expectation is. So For instance, I've seen a lot of managers that have really good historical numbers, but I know by following them that they're no longer doing what they were doing when those historical numbers were generated. So are you really buying those historical numbers, or are you buying something different? And that's the big concern from an allocator standpoint. Know what you're getting. And most managers aren't going to answer that question. And there's no way for you, unless you're on the inside looking at the changes that have happened in code, there's no way that you can know whether that's happened or not.
I should ask you, Alan, whether you agree with that question as an allocator.
I do absolutely know that it makes a lot of sense. And I mean, there are, Marty touches on style drift. I mean, that can come in different shapes or form. It can be, managing the volatility profile. That's one thing, or it can be just adding, some beta, which would be another. I mean, you would pick up the latter over time in the numbers, but obviously it wouldn't be evident in the full track record. So no, absolutely. I mean, it is, as we've said before, managers will always have narratives. It's the allocator's job to try and see beyond the narrative.
Yeah, absolutely. Final question, Marty, as we are at the beginning of 2023. Well, what are you most excited about when you look into the new year? And do you have any concerns for the new year?
No concerns. I'm excited to see. I really believe we're transitioning currently from a inflationary trade to a recessionary trade, which are two very different animals. So from a trend following perspective, there's going to be some pain related to that transition. I think we're seeing some of that early this year. I don't have a problem with that. I'm comfortable with that. I think the other thing is to see the growth and the development of DUNN in particular and the industry as a whole, because I believe that the industry is really coming into its own. I think this is different than 2007, 2008. I think people are starting to understand the value of a core allocation to this type of strategy. And I want to see it be more accessible to all parts of the investment community, not just institutionals, but the retail clients. I'd like to see the fee compression happen so that it's becomes profitable for retail, as opposed to having the fees so high that people aren't really making any money at it. So we're going to become more mainstream. And that's what I'm looking forward to, is the industry as a whole becoming more mainstream, being more accepted.
Good stuff, Marty. On that note, we're going to wrap up this fascinating conversation. Marty, thank you so much for being on the podcast and for sharing your thoughts and insights with us. We hope we can do this sometime again in the future. And to all of you listening today, I hope you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go check out the show notes of this episode and all the other resources you can find on our website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.